All right, my friends. Next up, Stephen Miles, CEO of Sharp Capital Advisors, in a fireside chat, an exclusive interview, we're calling this, right, with Elliot Lane, Director of Corporate Partnerships here at Benzinga. Steve, how are you?
Great, Patrick. How you doing?
I'm great. Thanks for joining us today. Elliot, I'll let you take it away, man. Enjoy.
Awesome. Excited to be here. Steve, this is our third conversation this year, and honestly, we have no shortage of things to discuss, to chat about. It's good to be back with you, my friend.
You as well. Good to see you.
Yeah, you too. So let's jump right in. I mean, honestly, for me, name of the game right now is how everything is responding to what's happening in DC. And I'd love to get your take on that. I'd love to also kind of understand your insights on the public markets. So starting there, can you give us, as you're very data driven, so can you give us some insights as to how the operational performance of companies is, being reflected or not being reflected in the stocks right now, in the public markets of the cannabis industry?
Yeah, well, it's crazy, isn't it? I mean, as you know, I'm a private markets guy, and most of my own wealth is in private opportunities, and even most of my cannabis investments are in private opportunities. But I am an investor in the public stocks as well, and it's just amazing to watch every quarter these guys come out and exceed analyst estimates for their financial performance, and their stocks just seem to keep going down. And I've talked to some guys that are money managers in the space, and it seems like there were, first you had a lot of real fast money come into the space when the Georgia election went Democratic, and a lot of belief that there was going to be, a lot of momentum on the federal legislative front. And, when that didn't happen, and as that continues to not happen, it continues to get pushed out, a lot of that fast money left the marketplace. I think at the same time, you had some structural issues inside of the market where there were some large holders that were needing to sell, institutions that had decided that they can't be clearing these types of accounts, but also, owners, sellers who had taken stock in these transactions when they sold their businesses to the large MSOs, looking to then sell those shares when they come off of lockup. And that's something that's going to continue to plague the industry. So you had this kind of perfect storm of fast money that made it pop towards the end of last year, leaving the market when the legislative action wasn't coming as fast as they thought, with some structural things underlying it where you had a lot of sellers and not a lot of buyers. And so the stock prices just keep getting depressed. It does seem like we've hit a bottom. I'm very excited about everybody in this office here, I put into these stocks over the past 12 months. I'm running around with a Bible talking about it all day long, and everybody's starting to wonder if I know what I'm talking about.
I love that. So,
as a fundamental investor, I mean, these stocks are, undervalued relative to their current performance and their future prospects. But this 280E thing, this needs to be resolved. The safe banking, this needs to be resolved. And until some of those things are actually resolved, or they appear about to be resolved, you're not going to have a big inflow of retail investors. And as a consequence, it's going to be hard to see a lot of lift in these shares for a while.
I hesitate making you say anything close to a prediction of safe. For me, I'll jump in first. I've heard safe plus in early 2022 is the goal. But I am bearish a little bit with hope. I'm bearish with hope is what I like to say.
Yeah.
But I don't know about your thoughts there.
Well, when you see these guys go to war over just increasing the debt limit to pay for bills that they've long since already spent the money, it's hard to hold out a lot of hope for them doing anything terribly productive. And
right.
I think you have this push and pull between wanting to get something done, but wanting to get everything done and deal with the social equity and the much larger issues. So I hope you're right. I mean, I hope that they slide it into another bill and get it done without too much of a fight, and kick the can down the road a little bit on trying to solve all of the larger issues associated with D-class. Because if they try to do that all at once, I don't see us getting it by the midterms. Then I don't see it happening, and we could be looking at, a long haul.
So And this is all related in my mind because all these public markets are so affected by every tweet Schumer sends out, or Republican Thomas Massey sends out from Kentucky the other day, something, very, very politically jarring for the cannabis space. But aside from playing politics, is it the best move for a large private SSO to look at the public markets right now? Yeah. And I group that all in as SPACs, as IPO, as RTOs. It seems they're fine the way they are, but I could be wrong.
Yeah, I think that's one of the real interesting things, Elliot, is that the debt capital markets have become and are becoming increasingly more liquid. And you've seen that with the big MSOs and where they've been borrowing at. I mean, Truly just took down a large chunk at 8%, which, kind of top ticks the market thus far. And I think you will continue to see that. You've had so many of these companies that have used all equity to date to build what they have, because that's really been the only source of capital other than sale leasebacks, which are a different topic. But and now it makes sense to start layering on prudent levels of debt. Mm-hmm. And you have a lot of, and the risk adjusted yields heretofore to debt investors have been kind of crazy, right? You can get 14 or 15% for a risk profile that in a normal industry would price more in the 6 to 7%, or perhaps even lower. So the risk-adjusted yields have been fantastic if you get over the fact that, the federal illegality aspect of it. And so now we're seeing a lot of capital flow into the debt markets in all manner, mortgage REITs that guys like AFC and Chicago Atlantic are doing, but just also funds and also, the public offerings to more retail investors of these debt products. So I think that's a great way for these private companies to stay private, not bring on a much more dilutive equity, and continue to grow their business. Now, the problem is with 280E, you don't get the deductibility of interest expense. This 280E thing is like weighing on the industry in such a meaningful way. Mm-hmm. And now that you have access to fixed income capital, but you can't deduct the interest expense, and you pay so much in your taxes that you can barely even cover the interest expense. It's frustrating because an industry that's such an amazing growth driver of employment, which should be, politicians, I would think one of their top concerns after defense would be employment. But the 280E thing just cast such a pall on this industry's ability to grow. And it's concentrating the ability to grow in the hands of these, 10 or 15 or 20 mega players who have access to capital.
Such an easy thing to fix. It really is so easy to fix, and it's just not.
You just pick that one thing for now and just fix it. But we see a lot of really, really good, strong, well-run, defensible private businesses that have access to capital, more expensive than it should be. That we're trying to help do exactly that. Just stay private, stick to your knitting. So many people have convinced themselves that the real value here is to be a multi-state operator. Let me be in 4 different states because therefore my business will be more valuable. It's a fatally flawed concept, other than for the majors who have already established those positions. If you're a single state operator and you've got a good business there, you should be focused on being a top 3 player in your jurisdiction. Be an efficient user of capital. Go deep, not broad, and that's where the value will be in the future. Not being in the number 10 player in 6 different states. That's not value enhancing.
You use my favorite phrase, almost depth versus breadth.
Right.
Yeah.
Right. It's just, because the MSO strategy has worked so well for the top 10 players that it's a natural inclination for every other player to think, oh, that's what I should do. Right. I got a pretty nice business here. Let me get a tentacle in this state. Let me get a tentacle in this state. And then I'll go public. Well, but to what end? If you really, if they had good advice to back up and say, what are you really trying to accomplish? If you're really trying to accomplish wealth creation, then let's look at the panoply of alternatives for how you could get there, other than just that one playbook that worked well once, but probably is not replicable.
Right.
The world doesn't need any more MSOs right now, publicly traded MSOs. There's not even enough capital support for the market as it exists today. And you've seen what's happened with these SPACs, the parallel SPAC, they just announced they're pulling that off. The Green Rose SPAC still hasn't closed yet. There's a reason for that, right? It's the public markets are not the right place right now for these types of market participants.
Mm-hmm. Well, I mean, that leads me to kind of a model footprint. I mean, I originally had this question focused on an MSO, but perhaps we can open it up to a model footprint for a private operator. Like, where do you see success in the private markets right now?
Well, and I'll take it for the public companies too. I mean, and I think that because I think that what you're going to see now is the highly competitive states that have been more or less ignored by the MSOs. When I say MSOs, I'm talking the kind of the top 10.
Yeah, tier one. Yeah.
MSOs. You know, they haven't been in California. When they have, that hasn't worked out necessarily particularly well. Colorado, Oregon, Michigan. And I think that you're going to start to see change. I think that people are going to be marrying very, very nice license footprints in limited license states with operators out of these competitive markets who have proven an ability to operate in a very, very competitive market. Who have shown that they can grow, that they can sell weed for $100 an ounce and be highly profitable. If you transpose that capability set to, you know, New York and New Jersey and Illinois and Ohio and Pennsylvania and Massachusetts, where this stuff trades for $4,000 a pound, that's where you're really going to get, you know, a real bang for your buck. And so I think you'll start to see the MSOs try to start to make acquisitions or partnerships or plays in those competitive markets to get that capability. I think you find that some of these guys in these more competitive markets are growing, you know, 4 times the amount per square foot that their compatriots are in these limited license states.
Wow.
So it's just and with better outcomes.
Mm-hmm. Wow.
Better marijuana. So, you know, I think you'll continue to see that on the private side. I just think exactly what I said before. You know, if the key to me for this type of business is to be a number one, a top 3 or 4 player in your marketplace for whatever it is. Now you might have a niche product and you're measuring yourself that way, but I'm not saying everybody can be a 1, 2, or 3 flower producer in their marketplace, but that's what you have to strive for. And, you know, that's really going to be where the value comes, because if you agree with the thesis that the world doesn't need any more publicly traded MSOs just now, then you're building a business so that it can pay meaningful dividends, generate meaningful cash flows for the existing owners. And if it's an exit you want, the exit you'll get is when the aforementioned federal events happen, and then you have different buyers and the existing buyers armed with a lot more capital, a lot better valuations. And when they come into markets to enter markets that they're not in, what are they going to do? They're going to buy the number 1, 2, or 3 player. They're not going to buy the 5th or 6th player. And then when they come into that market, if you were the 5th or 6th player because you've spread yourself thin to other markets and kind of ignored going deep, they're going to buy the number 1 or 2, 3 player in the market, and then they're going to kick the snot out of you.
Yeah. There's going to be no competition.
And start mowing people down. So we really encourage. There's so many great businesses out there. There's so many great business models. There's so many great companies that have developed a market position, and they really need to stick with it. And, you know, there's a lot of frustration out there, I think, right? I think a lot of people got into this thinking it was going to happen faster, or, you know, maybe it should have been easier, and they were going to make more money. And when you realize after 280E and after having to reinvest in the business and expand the cultivation and do this, that, and the other thing, they're not really making any money. And so, like, there's this frustration that's kind of setting hold, and it's leading people to make, you know, decisions I would prefer not to see them make, because these assets are valuable, and I hate to see people just kind of walk away from them out of frustration. But, you know, when you've got limited capital resources and the business isn't generating much of cash because of these systemic issues, you can see why people just kind of throw up their hands, and you're seeing a lot of that. It's causing a lot of problems because you have the buyers. Now the buyers are starting to think about the world that way. You know, they think that they're bailing everybody out.
Right.
So when you call them up and you have a really nice asset and you want to talk to them about it, their natural inclination is, well, this must be distressed. Why else would somebody, right? This guy must be exhausted. There must be a buy opportunity, and so they're not valuing businesses the way businesses should be valued in a lot of circumstances.
So I kind of want to shift gears a little bit. do you have thoughts on the ancillary side of this industry? It seems to me it's been very key to the public market side, but are you seeing a lot of competition in the private market side? It seems to me like a lot of the larger ancillary companies are really just the main ones that are at it right now.
Yeah, we have not seen much activity. We don't, we spend so much. We have a limited group of people and a limited group of resources too. So we spend almost all of our time on licensed operators, plant touching companies. So we unfortunately just don't have a real eye into that market. I am surprised that more of it doesn't just come across the transom. I mean, we just haven't really seen a lot of it. So some of the, technology platforms and the payment processing things, but then it starts to get into a world that we can't understand well enough to, feel like we could be effective.
Crypto coming into cannabis here.
Yeah, I mean,
Bitcoin.
I still don't know what that stuff is, and I got a colleague around here who made a fortune on Bitcoin, and I can't even figure out what it is.
I think I bought like 17 cents worth of Dogecoin, so I'm going to see how it grows.
I love that one just for the name, just making fun of the space. Yeah.
Yeah, Dogecoin. Although I think was it Shiba Inu, SHIB has been big. Anyway, besides the point, as we move into the end of the year, into next year, any particular markets? Last time we talked, it was Missouri. You told me about Missouri. I thought it was really, really nice. Analysis of what that market could be. Love what companies are coming out of the blue, like Heritage, into that market. But are there any other markets that are catching your eye right now?
Yeah, Missouri. I think that just today the ruling was handed down, striking the residency requirements. So now that market, and there's some nice businesses being built down there. They have the benefit of not having the MSOs in their hair, and now they'll have the benefit of when the MSOs now can come and buy these assets that they will have had this period of time to build without them there. So I like markets like that. There's other examples of markets like that, Mississippi, South Dakota. So these certainly for smaller private players that like the industry that are looking to build something, the whole Southeast at some point I think is going to be a very sorry, I've got to. Probably
they got to do what they got to do. I get
it's
it.
The police. I'm sure there's been another gangland shooting outside my window here in Chicago. But Michigan continues to be an interesting market. It's consolidating. There's Live Well went in there and really just changed the nature of the game in the state, and the state continues to grow. But some municipalities have licensed so many retailers, others have licensed no retailers. The ones that haven't licensed retailers are going to start licensing them because the others are making so much money. So now you're going to have too much retail. You have all this cultivation coming online, and like I said, Live Well came from Colorado, and they know how to produce good weed at a good price, and so they just kind of changed the game. So that's an interesting market. All the MSOs like it because it's so massive, but trying to figure out how to get in there and play it with all the locals who have been doing it for a while. So that's one to watch. It'll continue to kind of evolve. Illinois, with all these SEA licenses that just got awarded, I think there's Illinois is just a very fascinating market. You had a very limited license structure. A lot of it wasn't even necessarily built out. Now they have 185 of these new social equity applicants that have been awarded retail licenses, but they're allowed to trade them freely. So people are selling these things, just paper licenses. There's still the same, cap on the cultivation. There's only 21 cultivators allowed, and most of those are nowhere near built out to their capacity. So you're going to have this enormous supply-demand imbalance in the market as these new retailers come online. I couldn't pick one, Elliot. This industry.
That's good.
It's so fascinating. Good. And every state's different, and there's just and nothing's quite right. Everything's just a little bit off.
Yeah. Well, Steve, we've had 3 great conversations this year, man. I mean, we really have. I've learned a lot from you about, vertical integration at our last conversation, to state markets, to, the value of private markets, especially in where all the conversation is centered around what seems to be like the top 10 companies of this industry driving everything forward. It's nice to hear a perspective. Is there anything you want to talk or leave our audience with for the remainder of 2022? 2021 as we move into 2022?
Yeah, I think, again, I really think that this industry is, it's just really hard to, I would keep an eye on the publics, on the moves that they're making, keep an eye on their fundamentals. I mean, I think that's the best place right now for individual investors to do well, is to pick the top 5 or 6 of these guys, make sure you understand their strategy, make sure you understand what their cap stack looks like, how many shares they actually have outstanding. I'm always amazed. I listen to all these podcasts, and there's always debate about what the actual market cap of the company is, because people are not even sure how many shares there are outstanding, because there's so many levels of options and what have you. You need to pay attention to how many shares that they've issued in these acquisitions that they've done, and what type of lockups they're under, and when those lockups are going to come up, and if that's going to put downward pressure on the stocks. But I think you've got some really, really good companies in the top 10 MSOs. I mean, almost they all have slightly different strategies. I mean, True Leaf obviously is nothing like Air, but I think they're all really, really good companies. I think they're undervalued. I think that value is going to continue to be recognized by the market. You have to be patient, right? You have to be willing that it might take a couple years before you really have the type of declassification that we need in order to normalize this marketplace. Right. But meanwhile, they're really building fantastic businesses. And even if, the disclosure requirements out of Canada aren't the same, and you don't really know what the adjusted EBITDA is, this is an industry right now that, the vertically integrated players should be able to do 25 to 35% EBITDA margins. And it's a consumer packaged good that's growing 25% plus year over year organically. Not to mention new states that are opening up, states that are transitioning from medical to adult use, states like Illinois, where you only have 100 dispensaries, now you're going to have 285. People think about, there's going to be another 185 dispensaries, therefore the existing 100 are less valuable because now you're going to divide the same market pie by 385. That's not the way it works. Right. People are experimenting with the drug. There's so many new consumers coming to the marketplace. This is rough numbers, and it's not even close to being correct, I'm sure, and I'm sure everybody will challenge me. But, I was reading this article that something like 80% of U.S. people have consumed some liquor in the last 12 months, right? It's just an extraordinarily high number. Right. The number for cannabis is something like 12%.
Wow.
But the number for cannabis in the age group of like 18 to high 20s is like 44%. So, but this all makes sense. People that are born today or last year or 4 years, they're never going to think of cannabis as something that was illegal or that has some sort of negative connotation. It'll be ubiquitous. Yeah. The more that you have access to it, the more you can experiment with it, the more people will. And the medicinal benefits, all the things we know for why cannabis is better than alcohol. If you just extrapolate that out, the growth rates are astronomical.
They're massive.
You have great companies that are generating really good profits. You have good managers in there for the most part these days, I think. And so it's just up and away, but for you don't know when, right? Yeah. That's why my colleagues are always in here saying, why did you get us into these stocks again? But
I love that. I love that.
If you don't need the money right away, it's a great place to.
The opportunity's there. Yeah. Like Steve, fantastic, man. I appreciate it. Thank you for your insights. Patrick is kicking us off, but my friend,
the brothers,
it has been a pleasure with these
Lane
conversations.
Brothers. I'll see you guys in Vegas, I hope.
Yes, sir.
We'll see you there. We'll see you there. But here's my thing. I loved everything that Steve just said. I thought it was really interesting. I think it's really cool at the end of the day to hear from somebody who's looking at both sides, public, private, and not everybody does that anymore. It's very intriguing to hear Steve's take on things.
It's almost forgotten, in conversation, at least these days. So, I mean, the private industry is massive, and the opportunity is there. And Steve is a shepherd of that. And I love talking to him about it.
Love that. And I don't know where he got those numbers. He must have been coming to my house with all the alcohol and cannabis. I don't know what you're talking about.
All right. Well, you continue to enjoy your bourbon then, brother.
I will. Well, thank you. And on to the next. Thank you, Elliot.
See you guys.